Welcome to GEPL Capital Talks on Tuesday, a weekly podcast, bringing to you an interesting talk related to finance every week. Stay tuned. Subscribe now and press the bell icon to GEPL Capital's YouTube channel and never miss out on any stock market update and build your knowledge on investment. Hi everyone and welcome to our Talks on Tuesday weekly podcast. This is our episode number 61. Today we have with us Karan Pai, our technical analyst. Karan is going to tell us 3 features of option trading. So before we start, don't forget to hit the bell icon and subscribe to YouTube channel. We promise here to make investment easy for you. Over to you, Karan.
Hi, Lakshmi.
Okay, Karan, can you tell our listeners, first of all, what is an option contract?
Yeah, sure. So options are contracts that gives the bearer the right but not the obligation to either buy or sell an amount of some underlying asset at a predetermined price at or before the contract expires. So options are powerful because they can enhance an individual's portfolio. They do this through added income, protection, and even leverage. Depending on the situation, there is usually an option scenario appropriate for an investor's goal. A popular example would be using an option effective hedge against a declining stock market to limit the downside losses. Options can also generate recurring income. Additionally, they are often used for speculative purposes, such as wagering on the direction of a stock or index.
Oh, okay. And are there various types of option? Can you explain them in details?
Sure, Lakshmi. So an option is a derivative because its price is intrinsically linked to the price of something else. So there are two basic type of option contracts. First, call option. Call options are financial contracts that gives the option buyer the right but not the obligation to buy a stock, commodity or other assets or instruments at a specific price within a specific time period. The stock or commodity is called an underlying asset. A call buyer profits when the underlying asset increases in price. The specified price is known as the strike price, and the specified time duration which a sale is made is its expiration or time to maturity. You pay a fee to purchase the call option called the premium. This per share charge is the maximum amount you can lose on a call option. Call options may be purchased for speculation or as a hedge if you hold a short position in the underlying. Let us take a look at an example of, say, Reliance Industries. Hypothetically, let us say that Reliance Industries is trading at 2,300 rupees. You expect it to move higher, so you purchase a 2,400 rupee call, let's say again hypothetically at rupees 10. So in this case, 2,400 is the strike. CE means call European, and the 10 rupees paid is called the premium. It also mentions the expiry, which for this month is 30th September 2021. So if the price of Reliance moves higher, the price of the call option also goes higher, and vice versa if the price falls. The second option contract is the put option. The put option gives buyers of the option the right but not the obligation to sell a specific amount of an underlying security at a specified price within a specified time period. Put options are available on wide range of assets including stocks, indices, commodities and currencies. Put options increase in value as the underlying prices fall, as the volatility of the underlying prices increases. Let us look at the same example as before, but here you expect it to move lower. Let us say towards 2200. So you buy a 2200 PE at again a hypothetical figure of say 10 rupees. Now the buyer of the contract will be profitable if the prices of Reliance Industries moves lower towards 2200. Back to you, Lakshmi.
Okay, Karan, So now that we know what is call and put option and which of two you need to buy and when you need to buy it, tell me one thing, how is the premium of the contracts decided? Is it purely based on the underlying price or are there other factors involved too?
Lakshmi, I'm glad you asked that. So the option price is determined by various factors. One of them is the price of underlying. The other factors include value, volatility, and many others. These are called as option Greeks.
Oh, that's interesting. And can you tell our listeners, something more about option Greeks?
Yeah, sure. So options are actually speaking very complicated financial instruments. Greeks encompass many variables. So these includes delta, theta, gamma, vega, and rho, among others. So these might sound familiar, and explaining these in details might not be possible in this conversation, but I'll explain it. I'll give you an overview. So first, delta. So delta represents the rate of change between the options price for every rupee change in the underlying assets price. In other words, the price sensitivity of the option relative to its underlying asset. Delta of a call option has a range between 0 and 1, while the delta of a put option has a range between 0 and negative 1. For example, let us assume an investor is long call option of a delta of 0.5. Therefore, if the underlying stock increases by rupee 1, the options price would theoretically increase by 50 paisa, other things being equal. The second Greek is theta. Theta represents the rate of change between the option price and time, or time sensitivity, sometimes known as options time decay. Theta indicates the amount an option's price would decrease as the time to expiration decreases, all else being equal. For example, assume an investor is long an option contract with a theta of negative 0.5. The option's price would decrease by 50 paisa every day that passes, all else being equal. Theta increases when the options are at the money and decreases when the options are in or out of the money. The third Greek is gamma. Gamma represents the rate of change and options delta and the underlying assets price. This is the second order price sensitivity. Gamma indicates the amount the delta would change given a 1 rupee move in the underlying security. For example, assume an investor is long one call option on hypothetically Reliance. The call option has a delta of 0.5 and a gamma of 0.1. Therefore, if Reliance increases or decreases by rupee 1, the call option's delta would increase or decrease by rupee 0.1. Gamma is used to determine how stable the option's delta is. Here, gamma values indicate that delta would change dramatically in response to even small moves in the underlying price. The fourth Greek is vega. Vega represents the rate of change between an option's value and the underlying asset's implied volatility. This is the option sensitivity to the volatility. Vega indicates the amount an option's price changes given a 1% change in the implied volatility. For example, an option with Vega of 0.10 indicates the option's value is expected to change by 10 paisa if the implied volatility changes by 1%. The last Greek is rho. Rho represents the rate of change between an option's value and a 1% change in interest rate. This measures sensitivity to interest rate. For example, assume a call option has a rho of 0.05 and the price of 1 rupees 1.25. If interest rates rise by 1%, the value of the call option would increase to rupees 1.30, all else being equal. The opposite is true for put option. Rho is greater for at the money options with long times until expiration.
Okay, that was a lot of information to take in. Now, I would like to ask who these options contracts are for. I mean, can I participate in the options trading or do I use it as a hedge?
Okay, so participants in option markets are usually hedgers and speculators. So speculators enter the option market to make a quick buck with a very less investment. Let us look at our earlier example again. For
Okay.
example, buying one stock of Reliance would cost you 2300 rupees per share. But you can buy 2400 CE or the 2200 PE for 10 rupees. Bear in mind these figures are just hypothetical and not realistic by any means. So let us say you saw a breakout in Reliance Industries and you want to get on board the uptrend. So you would buy the 2400 call for rupees 10 and vice versa in case of the put. And then there are hedgers who look at options as a means to hedge their positions in the underlying. So for example, you are an exporter. You expect payments in USD by the month end and you feel that INR might appreciate and the pair might fall. So you might actually buy few contracts or puts to hedge your position.
Thank you. Thank you so much, Karan. This was really very insightful. And our topic for the next week podcast will be 3 financial ratios to track for a stock. Also, you can follow us on Instagram, Twitter, and Telegram for where we are talking all about investing for you. Thank you.